Trading a corner office view at Goldman Sachs for the dynamic, high-octane world of a hedge fund. Let's unpack what truly sets them apart. First, the work environment and culture. Goldman Sachs, as a bulge-bracket investment bank, often feels like a prestigious, highly structured organization. Think large teams, established processes, and a strong emphasis on client relationships and deal execution. The culture cultivates a sense of seniority and a career ladder climb through meticulous work and clear hierarchies. It's built on providing a broad spectrum of financial services, from M&A advisory to underwriting. Contrast that with many hedge funds. These are often more lean, agile operations. The environment can be more intense, with a focus on generating alpha or outperforming the market. You might find smaller teams, flatter structures, and a culture that embraces bold ideas and rapid experimentation. Now, let's talk responsibilities at Goldman. Your role often involves detailed analysis for clients, structuring complex deals, and managing long-term relationships. At a hedge fund, especially quantitative ones, responsibilities can lean heavily into developing trading strategies, managing risk on a portfolio level, and often making investment decisions directly. The pace is generally faster, with decisions needing to be made quickly based on market movements. This leads us to team structure and risk appetite. Goldman Sachs typically operates with larger, specialized teams. You might be an analyst in M&A, a trader on an FX desk, or an associate in capital markets. Risk is managed meticulously across vast business lines. Hedge funds, on the other hand, often have smaller, multi-talented teams. A single individual might be responsible for managing a portfolio, conducting research, and even executing trades. The risk appetite tends to be higher and more concentrated, as the primary goal is generating returns, often through more aggressive or specialized strategies. Finally, compensation models. Goldman Sachs compensation is typically a solid base salary with bonuses tied to individual, team, and firm performance. There's a level of predictability, even if bonuses can fluctuate. Hedge fund compensation, however, is famously skewed towards performance. While base salaries can be competitive, the majority of earnings often come from a share of the profits generated by the fund, commonly referred to as 22% management fee and 20% of profits. This means potentially much higher upside, but also greater volatility and a direct link between your results and your paycheck. Understanding these differences is key to choosing the right financial career path for you.